6.18 million. Okay, that is just a massive number, and honestly, it represents something completely unprecedented. In just 329 days, 6.18 million tokens have been permanently eliminated from circulation. To put that into perspective, that is a staggering 32% of this protocol's entire day one supply, just completely wiped out of existence.
Welcome to this explainer, everyone. Today, we're putting on our quantitative analyst hats to reverse engineer a truly fascinating financial machine, PLAZM's buy and burn engine. For the focused learner out there looking to understand exactly how wealth can be mathematically generated over multiple cycles without relying purely on market hype or price action, this is going to be incredibly insightful.
All right, let's dive right into this. We've got a fascinating quantitative deep dive ahead. We'll be looking at the compression engine, accelerating burns, the day 405 projection, the price divergence paradox, the wealth multiplier, and wrapping up with risks and our final verdict.
Part 1. The supply compression engine, the mechanics of buy and burn.
To really grasp this, we have to shift our mindset away from traditional crypto trading, where literally everything is about price going up, and instead focus on mathematical supply reduction. So what exactly is supply compression? Well, it's the continuous mechanical reduction of total token supply using protocol yield to buy and permanently burn tokens. And the kicker? It's completely independent of market sentiment. There's no human intervention here, no discretion. This machine runs purely on a 65% staking yield schedule. Literally 65% of all staking payouts flow automatically right back into purchasing and burning.
Think of it like a relentless factory. Step 1. Yield flows in from staking. Step 2. Those funds are used to buy PLAZM at whatever the current market price is. Step 3. Those tokens are permanently burned. And Step 4, because the total supply, the denominator in this equation, shrinks, the per token value mathematically rises for all the remaining holders.
And you guys, this engine has been working absolute overtime. To date, the buy and burn pool has spent a cumulative 111,510 USDC. On a daily basis, that translates to about $230 being deployed every single day, which right now removes roughly 12,777 PLAZM tokens from existence daily.
Which brings us to part 2, accelerating the burn rate, proof of exponential speed.
This is where the math gets genuinely wild. Because the elimination engine isn't just running at a steady pace, it's visibly speeding up. In cycle 1, spanning the first 77 days, the burn rate averaged 5.2 thousand PLAZM per day. But then in cycle 2, it jumped to 23.4 thousand a day. That is a staggering 4.5x acceleration. And tracking cycles 3 and 4 combined, we're currently sitting at an average of 47.8 thousand per day. Why is this happening? It's a self-reinforcing loop. More yield divided by fewer tokens creates a faster and faster burn rate.
Let's look at part 3, projecting to day 405, the Quant Model.
We've looked at the historical data, but now we need to apply a baseline quant model to see exactly where this multi-cycle frame ends up if these mechanics hold true. Tracking this supply decay curve tells a really dramatic story. We started on day 1 with 19.13 million tokens. Today, at day 329, we're already down to 12.95 million. But if we project this out to day 405, the end of the multi-cycle frame, we are on track to drop below the 10 million mark, hitting an estimated 9.87 million tokens. That represents a massive 48% total supply elimination.
And here is why that absolutely matters for valuations. According to the Quant model, by day 405, the valuation multiple hits 4.7x, based purely on this supply compression. Think about this. Even if the token price remains completely flat at 1.8 cents, this mathematical denominator shrinkage delivers roughly a 3.8x return for day 1 holders. It's exponential return driven by pure math, not market sentiment.
That brings us to part 4, the price divergence paradox. What happens if price drops? We just talked about what happens if the price is flat, but what if the market turns bearish? It's the obvious question, right? Does a falling token price just totally break the burn engine? In almost all of crypto, a price drop means sheer panic. But PLAZM's mechanics challenge that conventional logic head-on.
Let's contrast 2 scenarios to see why. In a bull market, $230 of yield buys and burns 12,777 tokens. But if a bear market hits and the price drops by 50%, that exact same $230 now buys and permanently burns 25,555 tokens. Because the vault runs on ETH yield and not the PLAZM token price, a cheaper token actually doubles the burn efficiency. Yield growth permanently increases the burn rate, sure, but short-term price weakness actually dramatically accelerates supply elimination.
Moving into Part 5, Wealth Concentration Multiplier, the shrinking pie.
We've established the pie as a whole is shrinking rapidly, but let's make this real and look at what that means for an individual holder's specific slice. Imagine you staked 100,000 tokens on day one. Out of the 19.13 million starting supply, you owned 0.52% of the network. Today, on day 329, assuming you haven't bought or sold a single token, you still have your 100,000 tokens. But because the total supply has shrunk to 12.95 million, your slice of the pie just organically ballooned to 0.77%. You literally gained a 48% concentration in ownership just by standing completely still. And look, your slice of the pie getting bigger? That isn't just about voting power. It has a direct financial impact. As the denominator shrinks, your share of the yield naturally grows. The baseline yield claim per token goes from just over 2 cents to a projected 4.1 cents by day 405. That means your yield essentially doubles, entirely due to the mathematical compression of the supply.
Finally, Part 6, Risks and Final Verdict, Sustaining the Machine.
As quantitative analysts, we always have to maintain objective credibility. This engine is incredibly powerful for sure, but it isn't magic. It has one fundamental vulnerability. It requires continuous staker inflow to generate that yield. Let's objectively walk through 3 scenario models. In the bull case, with 20% staker growth, the daily burn skyrockets over 60,000, supply plummets to 8.5 million, and yield hits 4.5 cents. In the base case, where staker growth is flat, the burn stays around 12 to 15K, taking supply down to 9.8 million. But check out the bear case. If staker interest declines by 20%, yield stalls, the burn drops to 8K a day, and the supply only compresses to 11.2 million. So the critical test for this entire thesis is whether the upcoming Cycle 4 entry can actually match the massive inflows we saw in Cycle 3.
So if you take nothing else away today, remember this. Supply compression is exponential wealth concentration across multi-cycle frames. This is arguably the lowest risk multi-cycle play out there because it relies purely on yield flow, not volatile market sentiment, and definitely not on fresh capital pumps to artificially raise the price. If the yield flows, the math simply works.
Which leaves us with one massive pivotal question. We are currently at day 329. Will days 330 through 340 see the robust staker entries required to sustain this mechanical elimination, or will the supply compression thesis need a serious recalibration? The data over the next 2 weeks is going to be absolutely critical. I highly encourage you to monitor the upcoming cycle data and test this mathematical model for yourself. Thanks for joining me on this explainer. Keep your eyes on the data, and as always, keep learning.